One of the key announcements made by the RBI in its monetary policy review was the revision of its inflation forecast for FY. The central bank has lowered its projection for retail inflation from 5.2% to 5.1% for the next fiscal year. This means that the RBI expects the prices of goods and services to rise at a slower pace than it had earlier anticipated. But what are the factors behind this revision? According to the RBI Governor Shaktikanta Das, there are several reasons for this downward adjustment. Some of them are the easing of supply-side constraints due to the relaxation of lockdowns and mobility restrictions across states, the moderation of global commodity prices, especially crude oil and edible oils, which have a significant impact on India's import bill and inflation, the favorable base effects, which imply that the inflation rate in the current period is compared with a higher inflation rate in the same period a year ago, resulting in a lower inflation figure. The normalization of food prices, especially fruits and vegetables, which have seen a sharp decline in recent months due to improved production and distribution. The softening of core inflation, which excludes food and fuel items, due to subdued demand conditions and weak pricing power of firms. The RBI also said that the risks to its inflation forecasts are evenly balanced, meaning that there are equal chances of inflation being higher or lower than its projection. Some of the upside risks are the persistence of high input costs and wage pressures, which could lead to higher output prices and inflation, the uncertainty over the evolution of the COVID-19 pandemic and its impact on economic activity and supply chains, the possibility of fiscal slippages at both the central and state levels, which could increase the government's borrowing and spending and fuel inflationary pressures. Some of the downside risks are the further easing of global commodity prices due to subdued demand and excess supply, the strengthening of domestic demand due to faster vaccination and economic recovery, which could improve productivity and efficiency and lower costs, the effective implementation of structural reforms and policy measures by the government and the RBI, which could enhance competitiveness and growth potential and reduce inflationary pressures. The RBI's inflation forecast is important because it influences its monetary policy stance and decisions. The RBI has a mandate to maintain price stability while supporting growth. It uses the repo rate, which is the interest rate at which it lends money to commercial banks, as its main policy tool to achieve this objective. A lower repo rate stimulates borrowing and spending and boosts growth, but it also increases inflationary expectations. A higher repo rate does the opposite. The RBI has kept the repo rate unchanged at 6.5% since October 2021, citing the need to balance growth and inflation concerns. It has also maintained an accommodative stance, meaning that it is willing to keep interest rates low for as long as necessary to support growth. However, it has also cautioned that it will not tolerate any deviation from its medium-term inflation target of 4%, with a tolerance band of plus or minus 2%. The RBI's revision of its inflation forecast for FY24 suggests that it is more confident about achieving its inflation target in the medium term. It also indicates that it is not in a hurry to change its policy stance or rate anytime soon. However, it will continue to monitor the evolving macroeconomic situation and act accordingly if there are any significant changes in its outlook. The RBI has paused its rate hike cycle by retaining the key lending rate at 6.5% after 6 consecutive hikes. This is a surprising move as most central banks around the world have raised interest rates to combat inflation. Why did the RBI decide to go for a pause, and what are the implications for growth and inflation? The RBI's rate hike cycle began in May 2022 when it raised the repo rate by 25 basis points to 4.25%. Since then, it has hiked the rate by a cumulative 250 basis points in 11 months, reaching 6.5% in February 2023. The RBI cited rising inflationary pressures and supply-side disruptions as the main reasons for tightening monetary policy. However, in April 2023, the RBI unexpectedly kept the repo rate unchanged at 6.5%, breaking the consensus expectation of another hike. The RBI Governor Shaktikanta Das said that the MPC decided to pause as inflation had moderated and growth prospects had improved. He also said that the RBI was ready to act if the situation demanded so. The RBI's pause was welcomed by many analysts and market participants who felt that further rate hikes would have hurt growth and investment. They argued that inflation had eased due to lower food and fuel prices and that core inflation remained stable. They also pointed out that India's growth outlook had improved due to higher vaccination coverage, fiscal stimulus, and global recovery. However, some experts cautioned that the RBI's pause could be temporary, and that it may have to resume hiking rates if inflation rises again. They warned that inflation risks remain high due to rising commodity prices, fiscal slippage, and demand pressures. They also noted that India's growth potential had declined due to structural issues such as low productivity, weak banking sector, and policy uncertainty. The RBI's pause in the rate hike cycle has implications for both growth and inflation. On one hand, it could support growth by lowering borrowing costs, boosting consumer and business confidence, and stimulating demand. On the other hand, it could also fuel inflation by increasing money supply, weakening the rupee, and reducing real interest rates. The RBI will have to balance these trade-offs carefully and monitor the evolving macroeconomic situation closely. The RBI's next policy decision will depend on how inflation and growth perform in the coming months.